Hey everyone. So today I want to make a video that kind of looked back at what we were looking at in class today, which was closing the general ledgers and preparing them for the next period. As you guys already know, when it comes to assets and liabilities and our owner's equity, what we're doing is we're balancing them and bringing the new balance forward into the new period. For assets like our inventory or our cash at bank, our accounts payable, accounts receivable, things like that, all these assets and liabilities, their balances can change pretty regularly. For other items that we've looked at so far, like our non-current assets, we haven't seen them change much. That will be occurring a lot more when we start looking at things like depreciation. But for now, we already know how to balance these. What we need to do is we need to look at how to close off our revenue and expense accounts. So this slideshow will go through a pretty comprehensive example of how we do it and why we do it. So let's jump in. So closing the ledger is really sort of the first step where we start to see all of our knowledge come together. We've looked at all the different assumptions and qualitative characteristics and accounting elements, and we've looked at how we go through double entry, and now we're really starting to apply all those rules that we've learned. This is where we can start to figure out things intuitively, and even if you didn't know how to handle a particular thing that you come across, you can start to use the rules that you know and apply those intuitively. And I think you'll start to see that as we go through. So at the end of the reporting period, we follow two processes: the balancing of accounts and the closing of accounts. So we balance assets, liabilities, owner's equity. We close off our revenue and expenses to profit and loss. Now, as we looked at in class, the reason why we close off these accounts is for two reasons. One, it allows us to actually calculate net profit, and we do this in a number of different spaces, but by doing it here, it gives us a double check. And also, it allows us to return the balances of revenue and expense accounts to zero, meaning that when we get to subsequent periods, they'll be prepared. Sorry, guys. Anyway, so at the end of a period, our revenue accounts always have a credit balance. So let's have a look at this. We have our sales revenue here, and obviously, if we're going to close this off to zero, we need to make a $10,000 entry in the debit side to make it balance. First off, in the general journal, it looks like this. Obviously, what we say is we go on June 30th, we go to our sales revenue account, and we put in $10,000 on the debit side. What is our cross-reference? Well, it's our profit and loss summary. And why do we do it? It's closing entry. So that's step number one. Once we've done that, we can post it to our ledgers, and it looks like this. Okay. Now, if we were to have our expense accounts and have a look at a few of these, we might have our cost of sales, we might have our advertising, maybe our wages, and we close these off the same way. We're going to have to make entries on the credit side of each of these. So we can see here in our journal, we've got 4,000, 2,000, and 1,000, and we can just balance these off with one debit entry to profit and loss. Again, putting these into the ledger, it looks like this. We're just following our own instructions and making sure that our cross-reference is always P&L summary. Now, looking at the profit and loss account itself, if we were to take the amounts of money that we had before, it would look like this. Pardon me. So we've got revenues of $10,000 and we've got expenses of $7,000. Obviously, the difference here is $3,000, and to make this balance, we're going to have to add a $3,000 entry on the debit side. Now, this is the process of transferring a net profit. And it's transferred directly to capital because it goes to the owner. So it looks like this. Okay. So when we look at our profit and loss account, that's what it looks like. And you can see it's balanced off at the 10,000. And this means that after balance day, it's at a zero balance and it doesn't exist again until the next balance day. Now, something that I touched on briefly was the idea of drawings. Now, if you go back to your definition of expenses, drawings is the one thing that is specifically mentioned as not being an expense. It fits the idea of being an expense, but it's actually an owner's equity account because every bit of inventory, every bit of cash that is taken out of the business is actually reducing net profit, but it's reducing the profits available to the owner, but it's not reducing net profit itself, to be more clear. So what we do is we transfer this directly to capital. So instead of going through the profit and loss account, it just gets transferred directly. So here we have our instructions saying that we go to our capital account, we put in $1,000 entry, and what is our cross-reference? Drawings. So when we go to our drawings account, we put in $1,000 on the credit side, and what is our cross-reference? It's capital. And all in all, this is what our capital account will look like at the end of the period. You can see that we've got our balance of $50,000. Okay, that should say balance, not balancing. I'm sorry. And you can see here our P&L summary. So we've transferred the $3,000 of profit, and over here we have drawings. So in order to balance out 53,000 and 1,000, obviously we need to put in a balance entry of 52,000, which is the balance that we're bringing forward to the next period. Okay? So it's really straightforward. If you guys take it slow, think about every step that you're doing. Okay? As for the exercises and things that need to be done, most of you have already moved really well through the check your understanding questions, and I'd like to see those finished off for Friday. As for the chapter exercises, I'd like us to complete 1, 2, and then 4, 5, 6. Okay? Also, in that time, we need to be making sure that we're keeping up to date with our notes, having examples of how we close these accounts off. So make sure that that's also being done. So yeah, let's go to our wrap up. This is our chance to get really comfortable with using the double entry rules that we've learnt, understanding and using our definitions of accounting elements and assumptions, qualitative characteristics on a more frequent basis. Rote learning how to close off accounts and how to balance entries and things like that isn't going to be as useful as to understanding why it's done the way that it is. If you can understand why it's done a certain way, you're not going to have to rote learn it because you can just go through the process in your head. You can say, okay, I have revenue and expense accounts that need to be reset to 0. How do I do that? Well, I need to put in an opposite entry. And that's always going to be to your profit and loss. Okay? Going through these processes and understanding them is the key to making sure that you're going to do really, really well with accounting this year. So I really encourage you not to rote learn these, but to understand why we're doing them. If you can do that, you'll be absolutely fine. Okay? And if you are having any trouble with it, please see me and let me know, and we'll work through it together. Otherwise, I hope you have a great evening, and yeah, I'll leave you with the questions that need to be done one more time, and I'll wrap it up with the meme. Thanks, bye.
Hey dude, dude, I made this pretty cool meme. I wanted to show it to you.
Oh, that's so funny. How'd you make it?
Well, you see, first I added this really colorful background, then this really funny cartoon of a salamander, and then this text, ask for a water cup and fill it with soda. I call it Sneaky Salamander. Oh, you want to know how to make a fresh meme? Well, let me show you. First, you take an oversaturated hallway, fill it with shadow demons, and then add some text like, me and the boys at 2 a.m. looking for beans!